In recent years, Texas has witnessed an intricate network of Chapter 313 agreements and bond referendums that have elicited significant controversy and concern. Elected leaders and local government entities have collaborated with school districts to offer tax abatements to private industries, ostensibly to attract businesses. However, the narrative surrounding these agreements is marred by allegations of fraud and corruption. The rationale presented by state leaders and school officials hinges on the premise that by entering into Chapter 313 agreements, school districts would entice companies to locate in their areas by granting them relief from normal tax burdens. The reality, however, diverges sharply from this initial premise. In essence, many school districts in north central Texas have forfeited over $1 billion in potential local tax revenue by engaging in contracts with solar and wind farm companies, particularly in counties such as Bosque, Ellis, Hill, Limestone, McLennan, and Navarro. These agreements have caused local school officials to overlook substantial revenues that could have been utilized to alleviate the financial strain on taxpayers and homeowners, whose properties have faced escalating taxes. Critics argue that the access of local taxpayers to information and processes relating to these agreements has been unduly limited. Meetings between school board officials and superintendents have often been conducted in closed sessions, leaving taxpayers in the dark. Legal counsel and consultants involved in negotiations have been funded by the very entities that stand to benefit from these agreements, creating a glaring conflict of interest. Consequently, taxpayers have been left without adequate representation or the ability to voice their concerns, raising questions about the integrity of the decision-making process. One notable example is the Itasca Independent School District, located in Hill County, where multiple solar farm projects totaling nearly $1 billion have been initiated. In a striking contradiction, this district is poised to present a third bond referendum within 3 years, seeking $32 million from local taxpayers while simultaneously forfeiting $84.7 million over a 10-year period due to the agreements with solar farm operators. This scenario illustrates a fundamental inconsistency in how school districts are funded in Texas, complicating the already intricate financial landscape. The violations and infractions associated with the management of Chapter 313 agreements are numerous. For instance, many taxpayers within the Itasca ISD have either been entirely uninformed about these agreements or have been denied access to critical information regarding the potential tax revenues they could generate. Taxpayers have not been granted a vote in this process, further exacerbating feelings of disenfranchisement. The district's reluctance to share requested information regarding projected tax benefits amplifies the frustration among local citizens. Moreover, taxpayers have raised serious concerns about the qualifications and experience of school board members regarding these contracts. The district has ignored inquiries related to board members' expertise and has failed to negotiate effectively. Instead, the agreements reached have often favored the solar farm operators at the expense of fair local tax contributions. The potential expertise of knowledgeable taxpayers has gone untapped, further perpetuating financial disadvantages for the district. Prejudice and bias displayed by school and appraisal officials illustrate another layer of this troubling scenario. The allegations highlight a concerted effort among school officials, legal counsel, and consultants to mislead taxpayers while prioritizing the interests of solar farm operators. By agreeing to the lowest taxable valuations for solar farms, school districts have effectively deprived themselves of significant local tax revenues. Despite the legal framework allowing districts to negotiate for better deals, these opportunities have largely been overlooked. Furthermore, a concerning pattern of bias against non-participating taxpayers has emerged. School officials have continued to levy heavy tax burdens on those not involved in the Chapter 313 agreements, unfairly reallocating the tax responsibilities from solar farm operators to ordinary homeowners who receive no tangible benefit. Landowners who have engaged in leasing their land to solar farm operators are enjoying financial incentives, while average taxpayers shoulder the growing tax load. Adding to the complexity is the interaction between bond referendums and Chapter 313 agreements. The juxtaposition of tax abatements granted to solar farms with the ongoing need for school districts to secure funding through bond measures has created a precarious financial situation. School officials are seeking to project increased tax revenues as part of future bond referendums, despite the uncertainty surrounding these funds. By presenting voters with measures that lack solid financial backing, school districts are risking the trust and support of their constituents. Taxpayers are gravely concerned about the implications of these financial maneuvers on their property values and overall economic stability. As the state enacts policies that may nullify the perceived financial benefits of these bond proposals, citizens find themselves in a precarious position. The potential shift in tax liabilities due to legislative changes can leave voters feeling deceived, as they may have unknowingly endorsed measures that do not align with their financial interests. The fallout from the May 2025 bond referendums is still unfolding, with allegations surrounding misleading financial conditions and deceptive practices marring the integrity of the process. Taxpayers have raised alarm bells regarding the failure of school districts to adequately disclose the ramifications of pending legislation, particularly concerning homestead exemptions. The interconnected nature of these financial instruments means that what voters thought they were supporting was not reflective of the actual fiscal landscape. In light of these developments, numerous taxpayers have filed complaints alleging fraud and corruption against school officials, calling for investigations into misrepresentation and a lack of transparency. The repeated patterns of obfuscation and manipulation by those in power have prompted citizens to seek legal recourse and push for accountability. The landscape of school funding in Texas is fraught with complexities that warrant immediate attention and intervention. There is an urgent need for regulatory reform, particularly concerning disclosure obligations related to bond proposals. School districts must embrace transparency and ensure that all potential impacts on taxpayer obligations are clearly articulated. Furthermore, rigorous oversight is essential to safeguard the interests of taxpayers and maintain the integrity of the bond election process. Implementing stringent regulations around the promotion of bond referendums can alleviate concerns about misinformation and manipulation, restoring public confidence in local governance. Ultimately, the dialogue surrounding property tax relief and school funding must be grounded in transparency and accountability. Taxpayers deserve a clear understanding of the financial implications of their decisions, particularly when it comes to complex agreements and capital projects. As the landscape of school finance continues to evolve, the intersection of ethics, governance, and fiscal responsibility remains crucial to safeguarding the interests of all stakeholders. Undefined. As communities strive to navigate these complexities, it becomes imperative that local officials adhere to principles of transparency and ethical conduct, ensuring that the voices of taxpayers are not only heard, but also respected in the decision-making process.